For over 80 years, one currency has ruled the global economy. It backed oil, financed wars, and shaped empires. But what if starting tomorrow, all of that changed? Imagine waking up one morning and realizing that the money in your bank account suddenly buys less, not because of inflation or a market crash, but because the world simply stopped trusting the US dollar. Today we are exploring what would happen if the US dollar lost its global throne. The US dollar did not become the world's most powerful currency by accident. It all started in 1944 at Bretton Woods, New Hampshire. As World War II neared its end, 44 allied nations gathered to rewrite the rules of global finance. They created a system where all major currencies were pegged to the US dollar, and the dollar itself was backed by gold at $35 an ounce. America had the largest gold reserves, the most industrial power, and emerged from the war with its infrastructure intact. Other nations gladly accepted this arrangement. But everything changed in 1971 when President Nixon ended the dollar's convertibility to gold. The world panicked, but only briefly, because a new system quickly took its place, the petrodollar. The US struck deals with oil-rich countries, especially Saudi Arabia, to sell oil only in US dollars. That one move cemented dollar dominance. Today, over 80% of global oil sales are still done in US dollars. Over time, the world started holding dollars for everything: reserves, debt, trade. The dollar became the bedrock of global finance because people trusted the US economy. This gave America what economists call exorbitant privilege. America could borrow more, pay less, and buy goods cheaply because the world needed its dollars. But today, that once unshakable status is starting to crack. A growing number of countries no longer want to rely on the dollar. One pressing concern is America's finances. The US national debt recently passed $37 trillion, a number so large it is hard to comprehend. The dysfunction surrounding it worries investors and foreign governments. In recent years, the US has come dangerously close to defaulting on its obligations, not because it could not pay, but because of political gridlock. What message does that send? That the US cannot be trusted to manage its own books. But there is something even more worrying: the way the US uses the dollar as a weapon. When the US imposes sanctions, it can block countries from accessing the global banking system, especially the SWIFT network. That is exactly what happened to Russia after its invasion of Ukraine and to Iran long before that. These nations were effectively locked out of the dollar-based economy. Their dollar reserves were frozen. Whether or not the sanctions were justified, one thing became clear: the US has the power to freeze entire economies at will. That power makes the dollar look dangerous to anyone who might one day fall out of favor with Washington. This is why many countries are quietly rethinking their dependence on the dollar. This movement is most visible in the actions of the BRICS nations: Brazil, Russia, India, China, and South Africa. These 5 countries represent more than 40% of the world's population and over a quarter of global gross domestic product. Russia began trading oil and gas in rubles and yuan. India signed a deal with the United Arab Emirates to pay for oil in rupees. In 2024, China bought crude oil from Saudi Arabia and paid in yuan, ending a 50-year tradition of pricing oil exclusively in dollars. Even France finalized a liquefied natural gas deal with China and paid in yuan. It was the first time a Eurozone nation had used the Chinese currency to pay for energy. Central banks are responding too. Instead of buying more US debt, they are buying gold in record amounts. In 2023 alone, central bank gold purchases reached an all-time high. Why gold? Because it cannot be frozen by sanctions or manipulated by foreign central banks. It is a timeless hedge against instability. All of this has fueled a global conversation that was once fringe but is now mainstream: de-dollarization. Over 100 nations are currently researching or developing central bank digital currencies, programmable state-backed versions of traditional currency. China is leading the way. Its digital yuan has already been used in cross-border payments with Thailand and the United Arab Emirates. The BRICS nations have also discussed launching a common settlement currency, but there is no clear replacement yet. The Chinese yuan is tightly controlled and not freely convertible. The euro suffers from political fragmentation, and a BRICS currency remains theoretical. For the first time in decades, the question is not if the world can live without the dollar, but how soon it might decide to try. So what happens if the dollar loses its throne? The first domino to fall would be a global sell-off of US assets, starting with treasury bonds. Countries like China, Japan, and Saudi Arabia currently hold over $2 trillion combined in US debt. If they begin dumping these holdings, the bond market reacts violently. Prices crash, yields spike. Suddenly, the US must offer much higher interest just to attract buyers. When treasury yields rise, interest rates across the board go up with them. Mortgage rates could soar. Credit card rates would surge. Small businesses would face much higher borrowing costs. The price of using someone else's money would become painfully expensive, guaranteeing economic contraction. At the same time, a weaker dollar erodes purchasing power. The US imports over $3 trillion worth of goods annually. If the dollar falls, every single import becomes more expensive. That means inflation, but something deeper and structural. In real terms, the dollars you already have will buy much less. The loss of global trust in the dollar undermines America's geopolitical leverage. The ability to impose sanctions, influence trade flows, and shape international financial rules is all tied to the dollar's dominance. Without that dominance, the US loses one of its most powerful tools. But here is the reality. Despite all the growing cracks, the dollar is deeply embedded in the foundations of the global economy. As of early 2025, the US dollar still makes up around 59% of global foreign exchange reserves. That is down from about 70% 2 years ago, but it is still more than double the euro share, which sits around 20% and far ahead of the Chinese yuan, which holds just about 3% of reserves worldwide. Central banks across the world still hold over $6 trillion worth of US dollars in reserves. Why? Because no other currency comes close in terms of liquidity, trust, and access to global markets. The euro has never fulfilled its full potential because the eurozone is politically fragmented. Unlike the US, Europe lacks a single unified treasury or common fiscal policy. The Chinese yuan has a major flaw. It is not fully convertible. Beijing tightly controls capital flows. That makes investors nervous. Trust is everything in the financial world. And despite America's rising debt and political dysfunction, global markets still trust the US system more than the alternatives. The dollar is woven into the machinery of global finance. The SWIFT system, used by more than 11,000 banks worldwide to settle payments, still operates primarily in dollars. Most global oil contracts are still priced and settled in dollars. Yes, de-dollarization is happening. It is real. But dismantling an economic system that took 80 years to build is not a weekend job. It is a process that will take decades, not days. Just like an aircraft carrier cannot make a sharp turn, the global monetary system does not pivot quickly. For now, the dollar still has momentum on its side. In the end, the collapse of the dollar will not happen overnight, but its dominance is quietly eroding. The shift is slow but real. A world with multiple currencies, rising risks, and fading privilege is already taking shape. The US is losing more than just a currency advantage. It is losing leverage, stability, and the luxury of unchecked debt. Now I would love to hear your thoughts. Leave a comment below. Do you agree with this? What is your take on the future of the US dollar? Your perspective really matters to us and helps shape the future of this channel.